let's get back to the this idea of the overbought.
Yeah.
Because you and Arusha, again, both with your fancy CMTs, learned a lot about different indicators. RSI being one of them. That's the relative strength index. And so this is kind of one of those oscillators that people look at and often say, okay, what's happening with momentum? And tell us a little bit about what you're seeing on this QQQ chart that you provided.
Yeah, so I mean, I think in this environment, as we mentioned previously, I think a market like this is innocent until proven guilty, and what that means for me is you look for signs that things might rotate lower, right? So you look for signs that we're near an exhaustion point. I always tell people you look for signs that we're in like the eighth or ninth inning as opposed to the second or third inning of a bull market phase, to use a baseball analogy. So one of the great ways you can look for to identify or maybe anticipate a market top is when you start to see a proliferation of bearish momentum divergences. And what happens is when price is going higher, sort of a healthy bull market phase, you tend to have stronger momentum on the way up, right? And it makes sense because an indicator like RSI is just looking at what's the average up day, what's the average down day. And if the market's going up, the up days are probably a lot stronger than the down days. And so the indicator is improving. But a lot of times at the end of a bullish phase, you have the price continue to go higher, but the momentum actually starts to slope lower. And what that means is you're actually starting to have some down days along the way that are a little heavier and heavier, usually indicates some selling, a lot of times some institutional selling, sort of a technical way of sort of anticipating a bit of a change. You're seeing that right now with the QQQ. You're seeing that with the S&P 500. You're seeing that with some of the winning technology names like an IBM. You're seeing that pattern of higher highs on weaker RSI or weaker momentum. Now, I would say that this is really a leading indicator, right? This is one of those red flag types of charts. So on my checklist of things that tell me this was a market top, this is like one of the first ones. It says, okay, we might be nearing a market top because we're seeing similar conditions and momentum that we've seen at previous significant market tops. And if you think back to like the 2020 high, the 2007 high, these are classic market peaks where you had weaker momentum even as the prices were going higher. It speaks to potential weakness underneath the hood. And that's what I think has me questioning sort of the dominance of the growth trade, the, I guess not as magnificent seven sorts of charts as you're seeing Apple and others start to diverge. This sort of divergence speaks to that it might be weaker and less of a dominance than we've seen off of that October low up until now.
Yeah, so when you see a condition like this, or at least the way I generally interpret it is, you don't run for the hills at this point. You just kind of have it in the back of your head and saying, okay, it could be getting weaker. If you are in some of those stocks that started to sell off, you lighten up on those, maybe cut your losses. And a lot of times what happens also, David, I know you know it, and I know Justin knows this too, but your batting average will start to, continuing with this baseball, your batting average is going to decrease, right? Where when you're at the beginning and starting in November and throughout the first few months here, batting average is probably like 80%. You're just hitting everything out of the park. But now it might be down to 50%. It might be 30%. You might be cutting more losses. And so it's those kind of subtle kind of things there that are telling you might be getting out of the sync with the market. It might be you. It might be the market. But you're keeping this in mind, this divergence. But you don't want to kind of like, because this is that lockout rally. It's been a lockout rally for the last 4 months. There were other signals out there saying, hey, it's getting too overheated and stuff like that. If you were too quick to get out, it's really hard to get back in, right? So it's that kind of that delicate balance.
And there is nothing worse, I think, as an investor than selling something up like 20, 30% and then leaving the next 200% and just sitting on the sidelines. Is there anything worse? And so you want to avoid that. So the way I think of it is, we used to print out way too many things, but we print out charts in my Fidelity days, and you had different piles. It was like the everything's great pile, just keep holding these. There was the clearly bad pile that I'm not going to touch. Then there was the question mark pile, like things that I'm actively watching. And I think something like a divergence is the kind of thing that would have me move it from the great pile to like the okay pile. And like, all right. And nowadays I would put it on a watch list. These are things, if I have a portfolio of 50 names and a couple of them start to show divergences, those go into my potential selling candidates to start monitoring them more closely and make sure that I have a good exit strategy in mind. And hopefully, honestly, I think at any point you want to have a good exit strategy, right? You want to be using trailing stops, whether it's a moving average or something to make sure that you're locking in gains and recognizing when things change. but the divergences just tell you starting to be an increasing likelihood or more and more likely that we're going to have some sort of pullback. So I just want to make sure I have a sense of what that might look like and what would I need to see on this chart to tell me to start to unwind some of that position. Where do I take 50% off? Where do I maybe, take all of it off? And I would say now is the time on charts showing that sort of pattern.
Yeah, definitely. It's kind of like that scenario analysis where you're saying, okay, this is something that could be down the road. I mean, look, if you're in a horror movie and you're like, gosh, there's a guy, he's down the road, he's got a chainsaw, he's pretty far away. Maybe I should tie my shoe.
Let's hide in the garage. Let's hide in the garage.
But there have been, and the way we look at it for those that have been, listening to IBD for a while and reading our stuff, we certainly pay attention to distribution days, right? Where you have those days where it's on heavier volume than the prior day, down more than 0.2%. And we have seen more of those days kind of clustering, but there are times where the market just doesn't care. We'll have those distribution days, for a while there, especially with the Fed, the quantitative easing, era where the TINA trade, there is no other alternative. You got to be in the market because where else are you going to get any return? It seemed like, you'd get distribution, maybe you'd go sideways, a blip, and then, you're right back. So are there times where you kind of say, look, the price is just too strong. I've got to ignore it. And the same way that you were talking about, like the overbought, it can get even more overbought. So are there times where you just kind of ignore it, or when do you kind of say, no, this is serious, I really need to pay attention?
It's funny. So I think the way that I like to approach it is, again, you think about, I always call it the primary trend. And I know I've read David Saito Chung and followed his, his market updates for years. I mean, what a fantastic, market practitioner. But he would always just reinforce sort of what sort of signals you're seeing. And for me, it's sort of take a step back. What is the trend? What's that primary trend? All right, now we start to look for signs that things are different. I think when a market's in such a significant uptrend that we've been in now off the October lows, it's not about the fact that we're going to make new highs, because that's probably going to happen, right? Pretty consistently. It's all about, do we undercut the previous swing low, right? You're really watching the lows on the way up. And as long as we pull back, which we're going to do, as long as we keep making higher lows, the chart's in a pretty good place. Where you want to be concerned is when we start pulling back and we stop making higher lows, right? When things start to really roll over. And that means you're seeing additional distribution. And I would say with sort of the O'Neill methodology, the distribution days would probably be part of that, right? Because you're pulling back enough and getting enough selling that it's sort of breaking a key level. I think those are similar ways of just showing we've seen broad accumulation and now something's different. So, and again, I think on most leading stocks, again, with some exceptions like a Tesla and others, most leading growth names, you've seen pretty consistent higher highs and higher lows. That's called Dow theory's uptrend. And I think you're seeing that in the S&P and the NASDAQ. So as long as that continues, as long as we keep having pullbacks, which we will, but as long as they keep pulling back to higher levels, we're still gaining ground on the upside. When we stop doing that, that's when I would get concerned.